Hello, this is J. Mike Perkins, and welcome to the Mortgage Education Channel. And on this episode, Reverse Mortgages Explained. You know, it's hard to turn on the television these days and not see some sort of a commercial for a reverse mortgage. But as much as people talk about these kind of loans, it seems like very few people actually understand how they work. So I'm going to explain it to you. Even if you are too young to qualify for a reverse mortgage yourself, if you have a parent or a grandparent that might be considering one of these loans and you're part of that decision-making process in some way, then this information will be very valuable to you. Initially, I'm going to cover what a reverse mortgage is. Then I'm going to go over the two different types of reverse mortgages, the home equity conversion mortgage and the reverse mortgage purchase program. Then I'm going to give you some important information that I think you need to know about reverse mortgages. And finally, I'm going to try to answer the question, who is the best person for a reverse mortgage and who is not? So what is a reverse mortgage? A reverse mortgage is a type of mortgage program that's available for people 62 years of age and older, which does not require the borrower to make any normal monthly mortgage payments. Now, you are allowed to make payments on a reverse mortgage, but normally if someone has gotten this type of loan, the reason that they did it is because they don't have sufficient income to make normal monthly mortgage payments. So typically, the reverse mortgage is paid off when the house is eventually sold. There are actually two types of reverse mortgages out there. The first one is by far the most popular one and the one you hear about mostly on those television commercials, and that's known as a home equity conversion mortgage. And with this mortgage, you borrow against the equity in your existing home. There's actually a second type of reverse mortgage out there that's known as the reverse mortgage purchase program. And if you have the ability to make a large down payment, which is typically somewhere between 45 and 62%, you are allowed to finance the remainder of the purchase price with a reverse mortgage. The first type is called a home equity conversion mortgage. And with this type of mortgage, you're allowed to borrow against the equity in your existing home. If you have a mortgage on your house right now, what will normally happen is if you qualify for the loan, the lender will pay off the existing mortgage and then they'll roll that balance into the new reverse mortgage. What is unusual about this loan program compared to other mortgage programs is the amount you can be approved for as a percentage of your home's value is not the same for everyone. It's based on your age at the time you apply for the reverse mortgage, and it's also based on the current interest rate. The older you are, and the lower the interest rate is on the reverse mortgage, the more money you will be allowed to borrow as a percentage of your home's value. Now, I can't tell you exactly how much you're going to be able to borrow at any age, but I went and did some research, and this is what the information that I came up with, and it should be in the ballpark. Let's assume that you apply for a reverse mortgage when you're 62, which is the youngest age possible. You're getting cash out or you're getting a line of credit. Let's assume that the interest rate on the reverse mortgage is 7% and that it's a non-FHA reverse mortgage with no separate mortgage insurance charge being added in. Let's assume your house is worth $400,000. Well, at age 62, you might only be allowed to borrow about 45% of the home's value. So the reverse mortgage balance couldn't be more than $180,000. If you have an existing mortgage right now of $200,000, well, you've got a problem and this program's not going to work. Let's look at another example on the other end. Let's say you go in and you apply for the reverse mortgage when you're 92. Same situation. You got an interest rate of 7%. Your house is worth $400,000. In this example, based on my research, you should be allowed to borrow somewhere around 68% of the home's value, which means that your loan amount could be as much as $272,000, which is obviously a lot higher than someone who's 62 and only allowed to borrow 180. With a home equity conversion mortgage, there are some options on how you get cash out, assuming that you are able to get cash out. You can get it in a lump sum distribution. You can get a line of credit that you can draw from whenever you need the money, or you can set up a fixed monthly payment to be sent to you every month. With a line of credit or a fixed monthly payment, you're only going to pay interest on the amounts that you've actually borrowed. The second program out there is called the Reverse Mortgage Purchase Program. This is designed for someone, again, 62 years of age or older, that is buying a home. If they're able to make a large down payment, and the exact amount is going to vary depending on your age and what the interest rate is on the reverse mortgage, but it's somewhere between 45 and 62% approximately. If you can make that down payment, then you will be allowed to finance the remainder of the purchase price with a reverse mortgage. The following is important information about reverse mortgages. They're very expensive. You can certainly shop around, you can try to negotiate with the lender, but it's not at all unusual to see lender fees of $10,000 to $15,000 on a reverse mortgage, plus your other normal closing costs. And also, if no payments are made on a reverse mortgage, the interest charges just keep adding to the balance, which means it just goes up every month. In the mortgage business, we call this negative amortization. For example, if you borrowed $300,000 at a 7% rate and you made no payments, after 10 years the loan balance is going to double, and the loan balance will double again in another 10 years. So if you hold a reverse mortgage for a long period of time without any payments, it's going to be very expensive. On a reverse mortgage, the property must always be owner-occupied, which means you have to live in the property for at least 6 months every year and consider it to be your primary residence. The lender is going to verify periodically that you are still living there. When the last borrower on the reverse mortgage dies, has to move somewhere else, or has to be hospitalized in a medical facility for 12 months or more, it's going to trigger repayment of the loan in balance in full, which normally means that you'll have to sell the home. The borrower on a reverse mortgage is always responsible for paying their own property taxes and paying for their own homeowner's insurance and any mandatory homeowners association dues. They're not going to be paid by the lender, and the lender is going to verify to make sure those have been paid. When the last borrower on the reverse mortgage dies, the reverse mortgage lender will work with the estate and give them a reasonable amount of time to complete the probate process. However, as soon as the estate is legally able to sell the home, the reverse mortgage lender is going to want some kind of evidence that it's been listed for sale. When the home sells, should the sales proceeds not be enough to pay off the reverse mortgage balance, the lender will accept the sales price as payment as long as the sales price was at least 95% of the house's current value. There are two types of reverse mortgages you'll see. One is an FHA loan, a Federal Housing Administration loan, and the other one is a non-FHA loan. Although they are both similar, there are several differences. FHA reverse mortgages generally have lower loan limits than non-FHA reverse mortgages. FHA reverse mortgages also tend to have slightly lower interest rates, but there's a catch. In addition to the interest charge, the FHA will charge you a monthly mortgage insurance premium, which is then added into the balance each month. On a non-FHA mortgage, even though the rate's a little higher, there is no separate mortgage insurance payment. So if you borrow the same amount of money on an FHA loan and on a non-FHA reverse mortgage, the payment amounts, the net payment amounts would be very similar. You can always refinance a reverse mortgage with another reverse mortgage, assuming, of course, you can be approved for the loan and assuming that you receive a, quote, net tangible benefit from the refinance, which will justify the cost. Now, why would you want to refinance a reverse mortgage? Well, if you wanted to switch from an FHA reverse mortgage with a lower loan amount to a higher loan amount on a non-FHA mortgage and then get enough cash out to justify the cost, that could be a good reason. Another would be if you had some combination of getting older, having the interest rate go down, and having the value of your home go up. If these things, some of them or all of them together, allowed you to pull additional cash out of the house and it was enough to justify the cost, that would also be a good reason. And finally, in summary, who is and who is not the best person for a reverse mortgage? Well, let's look at the negative first. Someone is not a good candidate for a reverse mortgage if they make enough monthly income to qualify for some other type of mortgage which will allow them to get at the equity of their property, because getting cash out through a reverse is just a very expensive process. And two, a reverse mortgage may not be a good idea for someone who is near the minimum age, who's around 62, who thinks they might live another 15 or 20 years. The reason is, if you get a reverse mortgage at the minimum age, 62, remember you can't borrow as much of your home's equity as you can when you get older. And two, you have a greater risk of holding on to that reverse mortgage for a longer period of time. And the interest, of course, will just make the balance go up and up. And by the time you have to sell the home, there may be no equity left. The best person to get a reverse mortgage fits the following profile. It's someone who does not have the monthly income needed to be approved for any other kind of mortgage to get at the equity in their property. It's someone who has a strong desire to live independently in their own home for as long as possible and will use the funds to pay for some kind of home health care so they can avoid moving to some type of assisted living facility. Given the high cost of a good assisted living facility, the cost of a reverse mortgage, the home health care, and the other expenses of owning a home may not be that much higher than the cost of assisted living. And finally, an older person is less likely to live long enough to have the compound interest be so high that it eats up all the equity in their home. So if they went to sell it, at least there would be something there. Thank you very much for listening. I hope you learned something. This is J. Mike Perkins.